Welcome back to the Pro Ticker Podcast.
Your Tuesday morning edition covering major financial magazine headlines.
Everyone
We've got a deep dive for you today.
exploring
Some major developments.
in the global financial markets.
We're talking China's economic maneuvers.
Some surprising U.S. market trends.
And of course,
That looming inflation data everyone's on edge about.
we've pulled together insights from CNBC,
Market Watch
The Wall Street Journal,
and Bloomberg.
giving you a multifaceted view of what's moving the market.
Exactly. And trust me, there are some aha moments in here.
That might surprise you.
All right, let's kick things off with China. CNBC is reporting that their Politburo just announced plans for more proactive fiscal measures.
And a moderately loose monetary policy.
What exactly does that mean?
Well, moderately loose on the monetary policy side suggests they're ready to lower interest rates.
And pump more liquidity into the system,
It's like loosening the belt on spending.
so to speak.
And on the fiscal side, proactive probably means we'll see the Chinese government spending more.
Likely targeting areas that boost domestic consumption.
Right. Think infrastructure projects.
Consumer subsidies.
Sounds like that.
It's all aimed at giving their economy a much-needed jolt.
So why should I care about what's happening?
On the other side of the world,
Because in today's interconnected world,
China's policies send ripples throughout the global economy,
a stronger Chinese economy means increased demand for raw materials.
which could impact everything.
From oil prices to the cost of building materials.
It's like my next home renovation.
Could get more expensive because China is building more bridges.
Potentially, yes. It's all connected.
And those lower interest rates in China could make their goods even more competitive internationally.
Affecting the prices of everything.
From electronics to clothing.
Interesting. So CNBC also highlighted how the markets have already started reacting to these announcements.
They mentioned the CSI 300 index saw a rise.
Yes, the CSI 300 tracks.
300 large companies listed on the Shanghai and Shenzhen stock exchanges.
That rise is a pretty clear signal that investors are optimistic about these measures.
And their potential positive impact on Chinese companies.
But the Hang Seng Index in Hong Kong had a bit more of a roller coaster ride, right?
Exactly.
It initially surged almost 3%.
But then those gains tapered off.
That suggests some investors might be a bit hesitant.
Perhaps weighing the implications for Hong Kong's own economic situation.
And CNBC also pointed out that China's 10-year bond yield actually hit a record low.
What's the significance of that?
That's a great question. Bond yields usually drop when investors are looking for safer bets.
It suggests that even with the initial positive market reaction, there's still some underlying anxiety about global growth prospects.
So it's like some investors are cheering.
But others are quietly heading for the bunker.
It's not quite that dramatic.
But there's definitely a sense of caution mixed in with the optimism.
And speaking of mixed signals,
CNBC mentioned a cosmetics company
Mao Geping,
that just debuted on the Hong Kong Stock Exchange.
their shares went through the roof, right?
Up as much as 87% at one point.
It's a stark reminder that even in the midst of broader economic uncertainty,
There are still pockets of opportunity.
especially for companies that are aligned with emerging trends,
It's like finding a rare flower blooming in a field of weeds.
a very apt analogy. And it highlights why it's so important to look beyond the headlines
And understand the nuances of individual sectors.
and companies.
Now let's switch gears.
And head over to the U.S. market. Market Watch had a fascinating article about something that's been happening under the radar.
A plunge in momentum stocks.
Right. While the S&P 500 as a whole has seen a fairly minor decline recently.
These momentum stocks have taken a real beating.
Okay, remind me again what momentum investing is all about.
It's a strategy where you're basically riding the wave of a trend. You're betting on the continued success of stocks.
That have already been performing well. Think of it as chasing the hottest stocks in the market.
So is this dip a blip?
Or are momentum stocks headed for trouble?
That's the million-dollar question.
And frankly, analysts are divided on this one. Some see it as a healthy correction after a period of exuberance.
While others worry it might signal a broader shift in investor sentiment.
MarketWatch mentioned a Goldman Sachs index that tracks these momentum stocks.
What happened there?
That index experienced its worst day in years.
Being over 6%.
It definitely grabbed people's attention.
So what does this mean for me?
If I've been invested in those high-growth tech stocks that everyone's been talking about,
It's a good time to take a step back and reassess your portfolio. Ask yourself if your current investments still align with your risk tolerance.
and long-term goals, maybe it's time to diversify a bit, explore other sectors.
That's sound advice.
And speaking of predictions,
MarketWatch had another insightful article about how wrong Wall Street has been with their S&P 500 forecasts.
It's almost comical how far off some of those predictions were.
They were expecting the S&P to end 2024,
Around 4,800.
but it's actually closer to 6,090.
They seem to have completely underestimated the market's resilience.
It's a perfect illustration of what Howard Marks calls the illusion of knowledge.
We crave predictions because they make us feel like we have control.
But they're often based on flawed assumptions or an incomplete understanding of incredibly complex systems.
So should I just completely ignore market predictions then?
Not necessarily.
But take them with a grain of salt.
No one has a crystal ball
Predictions are just one piece of the puzzle.
when it comes to making investment decisions.
That makes sense. Now, shifting gears a bit, let's talk about the big news everyone's waiting for. The U.S. Consumer Price Index,
Or CPI.
which is set to be released soon,
This is the key inflation data.
that everyone's been watching.
And it could have a major impact on the Fed's upcoming decision on interest rates,
So will inflation keep cooling off?
giving the Fed room to cut rates again.
That's the big question.
Or will a hot CPI print make them slam the brakes on those plans? Either way, their decision has real-world implications for all of us.
How so?
Interest rate changes affect everything from the cost of borrowing for businesses
To the interest you earn on your savings. It's like a ripple effect that touches nearly every part of the economy.
And it's not just the U.S. Fed that's in the spotlight. CNBC reported that the European Central Bank.
Is also widely expected to cut rates.
Right. And there are even hints that Australia might follow suit. There seems to be a global push to stimulate economic growth.
Driven in part by concerns about slowing demand and a potential recession.
So with everyone cutting rates at the same time, what does that mean for global currency markets and investment flows?
It seems like it could create quite a stir.
Absolutely. And that's something we'll be keeping a close eye on. What's fascinating here is that these decisions are all happening in the context of China's stimulus efforts.
It really underscores how interconnected the global financial system is.
It's a lot to process.
It is. But understanding these connections is key to navigating these complex times.
And potentially capitalizing on the opportunities that emerge.
Stay tuned because we're just getting started.
Speaking of China, let's dig a little deeper into their current economic situation.
The Wall Street Journal had an interesting piece about their inflation data.
Oh,
I
yeah.
remember that one. It said that China's consumer price growth,
Actually slowed down in November,
while factory prices,
showed some improvement.
but were still declining overall.
Exactly.
And that points to a persistent problem: weak domestic demand.
Despite all those stimulus measures we talked about earlier.
They're still struggling to get consumers and businesses to open their wallets.
And spend.
It seems like convincing people to spend is a lot harder than just pumping money into the economy.
You got that right. And this is partly due to the ongoing property downturn.
In China.
It's been dragging on for a while now.
And it's having a ripple effect on consumer confidence.
That makes sense.
When people are worried about the value of their homes,
Their biggest asset.
they're probably less likely to go out.
And splurge on other things.
Precisely. The Wall Street Journal even mentioned that sales at China's top real estate companies,
Actually dropped in November.
which reversed the gains they had seen the previous month.
That's not a good sign.
So what's the solution here? What can China do to get people spending again?
Well, the article suggested that they might need to take even bolder steps,
With their fiscal stimulus.
specifically targeting measures that directly boost household spending.
And support the struggling real estate sector.
So instead of just encouraging people to buy,
New appliances or cars,
they need to address the root cause of the problem
which is this lack of confidence.
in the property market.
Exactly. And this is where things get really interesting.
Because China's top leaders,
Are expected to meet soon for their annual Central Economic Work Conference.
right, that's where they set the economic agenda for the coming year,
I bet economists and investors around the world
will be glued to their screens,
looking for any hints about what policy changes?
are in store.
Absolutely. Many are hoping for more aggressive.
Consumption-focused measures that can really kickstart domestic demand. It'll be fascinating to see what they come up with.
Definitely. Now, before we move on, I want to circle back to something we discussed earlier. That record low Chinese 10-year bond yield.
What are the implications of that?
For global investors.
It's a sign that even with the potential for increased economic activity from China's stimulus, investors are still looking for safe havens. They're not quite ready to go all in on riskier assets.
So it's a mixed bag of signals coming out of China, some positive, some cautious. Speaking of the caution, we also talked about the U.S. dollar's recent performance.
CNBC noted that it's been strengthening,
Against the yen.
and that's happening even though the markets are anticipating another interest rate cut.
From the Fed.
It's a bit counterintuitive.
It is. Why would the dollar be getting stronger?
If interest rates are expected to go down,
It seems like investors are still viewing the dollar as a safe haven.
despite the potential for lower returns, the article even quoted an analyst who said,
The risk of persistent inflation
and fewer Fed cuts next year.
is a major concern right now,
So there's still a lot of uncertainty about the economic outlook.
both in the U.S. and globally.
You got it. And speaking of uncertainty,
Remember those momentum stocks we were discussing?
well, that MarketWatch article about their recent plunge really highlighted the risks of chasing trends,
Then the market.
especially when those trends are driven by speculative bets.
On high-growth companies.
Right, those companies that everyone's betting will be the next big thing.
But what if they don't live up to the hype?
Exactly. The article even quoted a technical analyst who pointed out that whenever the daily momentum index has dropped by at least 4%,
While being near its 52-week high
it's often been followed by some pretty turbulent times.
in the market.
So it's like a red flag.
A warning sign that things could get choppy.
Precisely. And the analyst also said that the S&P 500,
Has recently shown some other concerning patterns,
like a stretch of gains,
where more stocks were declining.
then advancing each day,
It's almost like the market's overall strength.
is masking some underlying weakness.
That's a bit unsettling.
So should investors be bracing themselves for a bumpy ride?
It's certainly a possibility. Another market observer, who writes the Macro Tourist blog, echoed this sentiment. He said that while options dealers are currently helping to stabilize the market,
That support might disappear.
once we get past the end of the year,
And when that happens,
the market could become much more vulnerable to sudden swings and unexpected events.
it's like walking a tightrope.
Without a safety net,
So buckle up.
it could be a wild ride. Now shifting gears a bit, MarketWatch also had an interesting article about PIMCO
One of the world's largest bond managers.
and their outlook on U.S. debt.
Ah, yes.
They're talking about the concept of bond vigilantism.
Bond vigilantism.
That sounds intense.
It is. Imagine investors collectively deciding to sell off U.S. Treasury bonds.
Because they're worried about government spending.
This drives up borrowing costs for the U.S. and forces them to make tough choices like cutting spending.
Or raising taxes.
That's bond vigilantism in action.
So it's like investors using their financial clout to try and influence government policy.
Exactly. And PIMCO is concerned about this because they've been reducing their exposure to longer-term U.S. Treasuries. They're worried about the growing U.S. deficit.
And the potential for bond vigilantism to kick in.
So they're basically saying that if the government doesn't get its fiscal house in order,
Investors might start demanding higher returns,
debt.
which would make it even more expensive to borrow money.
Right. And they also pointed out that the U.S. has been relying on this social contract of large deficit-fueled growth, which has led to technological advancements.
And benefited U.S. companies.
That's stock investors.
But they're worried that this model might not be sustainable in the long run.
Exactly. They believe that it makes sense to keep investing in U.S. equities, but prefer debt exposure in Europe.
Where they see stronger fiscal positions.
So they're recommending a shift in investment strategy, moving away from U.S. debt and towards European debt and U.S. stocks.
It's interesting how this ties back to our earlier discussion about China's stimulus efforts. It seems like there's a growing sense of unease about the global economic landscape.
With investors seeking out pockets of stability.
And safety.
That's a great observation. And this uncertainty is also reflected in the gold market. Remember those CNBC articles about gold prices?
Hitting a 2-week high.
Yes.
Yeah.
What's driving that rally?
It seems to be a combination of factors. There's renewed buying from China's central bank, plus anticipation of further interest rate cuts.
From the Fed.
And the European Central Bank.
So investors are turning to gold because they're worried about inflation.
Economic instability.
And geopolitical risks.
Exactly. And it's not just individual investors who are flocking to gold. CNBC also reported that China's central bank
Has resumed buying gold.
after a 6-month break.
Wow, that's a big deal. It suggests that even central banks are getting nervous and looking to diversify their reserves.
With safe haven assets. This increased demand from central banks is likely to provide further support for gold prices.
So gold is back in fashion as a safe haven, reflecting the current mood of caution and uncertainty.
In the markets. And speaking of uncertainty,
There were also articles
on CNBC.
and Bloomberg
About the situation.
In Syria.
Ah, yes. The fall of the Syrian regime and the potential implications for oil prices.
And global stability.
Syria itself isn't a major oil producer, but its strategic location.
And ties to Russia.
And Iran.
Make the situation incredibly complex.
Exactly. And the potential for further instability in the Middle East is adding to the overall sense of risk and uncertainty.
In the markets,
It seems like there's a lot to keep investors up at night these days.
there is. But remember, risk and opportunity often go hand in hand. Even amidst all this uncertainty, there are still potential opportunities for investors who are willing to do their homework. Stay informed and think strategically.
That's reassuring. Now, before we wrap up, there was one more article from Bloomberg I wanted to touch on. It was about the European Central Bank.
And their ongoing debate over how much further.
They can cut interest rates.
Right. It seems like there's some disagreement among ECB officials.
About how effective those cuts will be in stimulating the Eurozone's economy.
Some officials believe that further rate cuts are needed to encourage spending,
And investment.
while others are more cautious, arguing that the Eurozone's problems run deeper than just high interest rates.
Exactly. It comes down to whether the problems are primarily cyclical, meaning they're related to the ups and downs of the economic cycle,
Structural
meaning they're more deeply rooted.
and difficult to fix.
And those who believe the problems are more structural argue that rate cuts might not be very effective.
And could even do more harm than good.
They worry that rate cuts could limit the ECB's options in the future.
That's a tough call.
For them, for sure.
Especially with all the political turmoil happening in France and Germany, the Eurozone's two largest economies.
Right. CNBC even mentioned that the upcoming ECB meeting is being overshadowed by these political challenges. It's yet another layer of complexity.
To consider
It's like trying to solve a Rubik's Cube.
while riding a roller coaster.
Now, before we move on, I want to touch on a few interesting company-specific developments that caught my eye.
Sounds good.
What did you find?
Well, MarketWatch had an article about MicroStrategy and their continued purchases of Bitcoin.
They're really doubling down,
On that bet.
even as Bitcoin has become increasingly volatile.
It's a risky strategy,
For sure.
but it seems to be working out for them so far. Their stock price has surged alongside the price of Bitcoin.
But the article also mentioned that these Bitcoin purchases have come at a cost for MicroStrategy's shareholders.
You're referring to the fact that they've had to sell a lot of stock to finance these purchases.
Which has diluted the value of existing shares.
Exactly. And while investors might be happy with this strategy as long as Bitcoin prices are rising,
If Bitcoin prices fall,
or if MicroStrategy's stock underperforms Bitcoin.
the cost to shareholders could become more apparent.
It's a gamble, no doubt about it. And it highlights the importance of understanding not just what you're invested in, but also how those companies are making their decisions.
Speaking of risky bets, there was another article on CNBC about NVIDIA, the AI chip maker,
They're facing a probe by Chinese regulators.
over potential anti-monopoly violations.
That's a big deal.
China is a key growth market for NVIDIA, and this investigation could create a lot of uncertainty for the company.
And its investors.
It's unclear how long it will take. Oh, that's right. Their shares actually fell on their first day of trading.
Not a good sign.
Seems like investors are becoming more cautious about the outlook for food delivery companies as the pandemic-fueled boom in demand.
It starts to fade.
And this is likely to create challenges for Delivery Hero and its competitors as they try to maintain their growth.
And profitability.
It's a reminder that even in rapidly growing industries, there can be periods of volatility.
And uncertainty.
And that's why it's so important to carefully evaluate the fundamentals of any company,
Before investing,
no matter how exciting.
the industry might seem.
Okay, so we've talked about China's stimulus efforts,
With U.S. dollar strength,
momentum stock volatility,
bond vigilantism,
the renewed interest in gold,
geopolitical risks,
in Syria.
and even some specific company news.
It's been a whirlwind tour of the global financial landscape.
But amidst all this complexity, there's one final data point we need to discuss.
Oil prices.
Ah, yes. Bloomberg had a fascinating article about how oil prices have been impacted by both the situation in Syria.
And China's stimulus plans.
It seems like those two factors are pulling oil prices.
In opposite directions. The fall of the Syrian regime is creating geopolitical uncertainty and raising concerns about potential disruptions to oil supplies.
Which is putting upward pressure.
On prices.
While China's pledge to increase stimulus is boosting hopes for stronger oil demand, which is putting downward pressure.
On prices.
So it's a tug of war.
Between geopolitical risk and economic optimism.
Exactly. The Bloomberg article even quoted an analyst who said that further strength cannot be ruled out in the immediate future.
But that without a discernible improvement in the underlying oil balance.
It will be a strenuous process to sustain the current rally.
So it sounds like oil prices could go either way in the short term.
Depending on which factor proves to be more influential.
Right. And it's a reminder that oil prices are influenced by a complex interplay of factors, including global supply and demand, geopolitical events.
And investor sentiment.
It's a market that's always full of surprises. Well, we've certainly covered a lot of ground today.
We have.
From China's economic policies to U.S. market trends to the global outlook for inflation.
And interest rates. We even delved into specific company news.
And the impact of geopolitical events.
It's been a comprehensive deep dive.
Into the world of finance.
Absolutely. And I hope our listeners feel well equipped to navigate this complex and ever-changing landscape.
I'm sure they do. We've given them the knowledge and insights they need to make informed decisions and stay ahead of the curve.
It really has been a whirlwind tour, but it highlights a crucial point. Even when we're talking about these massive economic forces.
Like China's stimulus or potential rate cuts.
Individual companies are still making their own moves, and those moves can have a big impact on your portfolio.
Even if you're not directly invested in those specific companies.
Exactly. It's all interconnected. A perfect example is MicroStrategy, that company we talked about earlier.
That's gone all in on Bitcoin.
MarketWatch had a piece about them buying a huge amount of Bitcoin recently.
Over 21,000 Bitcoins.
Spending more than $2 billion.
And what's fascinating is how they paid for it. They didn't just have billions sitting around.
So they issued more shares of their own stock.
So they diluted the ownership for existing shareholders.
All to get more Bitcoin.
It's a bold move.
And so far, it's paid off. Their stock price has skyrocketed this year.
Mirroring Bitcoin's gains.
But as the article pointed out, it's a risky strategy if Bitcoin takes a tumble.
MicroStrategy is going to feel it even more.
They've essentially doubled down on that bet.
It's a good reminder that even in a diversified portfolio, a single holding making a really bold move can have an outsized impact.
So even if I don't own MicroStrategy myself,
this is something to pay attention to.
Absolutely. It highlights the importance of understanding not just what you're invested in, but also how the companies you own are making their decisions. What's their strategy? What risks are they taking on?
That's a great point. Speaking of company decisions, CNBC reported on a few other interesting moves.
NVIDIA, the AI chip giant, is facing an antitrust probe in China.
That's a significant development. China is a massive market for NVIDIA. And this investigation adds a whole layer of uncertainty for investors.
Even if NVIDIA's technology is top-notch, if they can't fully access the Chinese market, it's going to impact their growth potential.
It's a classic example of how geopolitical factors,
not just pure business success,
can make or break an investment.
And on a slightly lighter note, CNBC also mentioned the not-so-stellar debut of Talabat,
a food delivery company in the Middle East.
Oh, yes. Their shares actually fell on their first day of trading, which suggests investors are becoming a bit more discerning about that sector.
After all, the pandemic-era boom in food delivery has cooled off, so the growth story isn't quite as compelling as it once was.
It's a good reminder that even when investing in themes like the rise of online services, individual companies within that theme can have very different fates.
So we've covered a lot of ground today.
China's stimulus efforts.
Looming inflation data.
The way individual companies are navigating these turbulent times.
And it's all connected. What happens with interest rates impacts what companies can invest in, which impacts their stock prices, which ultimately impacts your portfolio.
It can feel overwhelming.
But that's exactly why we do these deep dives, to help you connect the dots, spot those aha moments, and come away feeling more informed, not more confused.
And with so much in flux, the key takeaway for you is this. Stay curious. Don't just react to the headlines. Dig deeper to understand the why behind the news.
Because that's how you make truly informed decisions, whether you're adjusting your portfolio or just trying to make sense of the forces shaping the world around you.
This deep dive was just a starting point. There's always more to learn.
More to explore.
But with this foundation, you're well equipped to keep questioning, keep connecting those dots, and make the most of the opportunities that arise in this ever-evolving financial landscape.
So until next time, stay curious, and thanks for joining us on the Pro Ticker Podcast. We'll see you all tomorrow morning with new headlines from major financial magazines.